Welcome back, investors, to Ticker Time News. I'm Adam, and there was some up and down price action today in a very narrow trading range, leading to a mixed market that followed form with mixed earnings reports this morning and mixed economic data. Fresh buying interest of the final hour of trading sent major indices to their new session highs for the day, before finally selling off in the final hour of closing. And you can see that here on the chart. This is the 15-minute time frame for the SPX, which tracks the S&P 500. It was a roller coaster, up and down and up and down, and really going nowhere. When we look at the bigger picture, going to the daily chart, let me click one other button here to make this a little clearer to see. And then, yep, there we go. And then we'll spread this out. You can see over the past 3 trading sessions, since hitting that trifecta of resistance points, the S&P 500 has been going nowhere. The one bullish bias that I want to point out on the chart here is the fact that yesterday and today both closed above the 5-day EMA, which is the most frequently tagged moving average there is. And as long as you're above that, you can call that short-term bullish bias. But as soon as you dip below it, then that's short-term bearish bias. So we are in the, I would say, neutral stage right now, because the market has been flat for the past 2 days since hitting that trifecta of resistance, but it is still above that. So there's a little hope that potentially it could tick higher and maybe force itself into another resistance area just by moving sideways and wedge it, and it'll have to do something at that point. So I think we're in a neutral stance right now, even though the short-term bias is on the bullish side, at least temporarily. The long-term bias is still bearish because it hit resistance that has been a steel bar. Right? The market could not break through this resistance back here in the end of March after that beautiful snapback and very steep rally. It hit that, boom, it was over with. And now we did the same thing, except there was a trifecta. There were 3 resistance points for the S&P 500. Now, there was a total lack of conviction on either side of the tape, and volume was on the lighter side today. That doesn't really work well for a market to move either up or down. That's why we got stuck in the middle today. Now, mixed action saw the mega cap stocks trading roughly in line with the broader market. And you know that over this entire rally that we have had, whether it's a bear market rally or not, mega cap stocks have been directional leaders, meaning if they go up, the market follows. If they go down, the market follows down too. So keeping an eye on mega caps is important. So I do want to point out about the small caps and mid caps. They did outperform the market today. Looking over here on the side of the chart, we've got the SPY. I'll pull that up. It was up about 0.2% today. Again, going nowhere, trifecta of resistance. That really 200-day moving average was a tough one for it to break through, and it did not. It got rejected there, so it's moving sideways. But it is still within the weekly expected range for the SPY, which the top end of that is 434.7. The bottom end is 419.4. By Friday, tomorrow, I'd imagine that the options market's going to get this one right, which it is 68% of the time. It is correct, and it'll get this one right too, because I highly, highly doubt the SPY, the S&P 500, is going to go out of this range at all tomorrow in price action. Now, look at the QQQ, and you'll see a very similar pattern. It did not get to its 200-day moving average to even test it. It just got slowed down at a resistance that it broke through, back tested, and the back test failed, sending it back below this red line here, which is resistance for the Qs. And that resistance is about where it's at right now, 330. That is a resistance area for the QQQs. Now, the weekly expected move, again, I think the options market is going to get this one right. I highly doubt it's going out of it tomorrow. The top end is 338. The bottom end is 322. It's likely to stay right around that 330 mark. So let's talk about small caps. Let's go to the IWM, which tracks the Russell 2000. Small caps and mid caps outperformed the broader market today, and that's a good thing. However, it broke above the Russell 2000, the IWM. It broke above its 200-day moving average, and it marched higher, but it got rejected where this red line is here. You can see the volume. Let me highlight it. The volume profile over here, it sticks out to about this area right here. And that is exactly where we are getting chopped around with small caps. But they did outperform today. But today, it ran up to its 200-day moving average and it stopped. The 200-day moving average is at 199.2 and it closed at 198.9. So just a few pennies under that 200-day moving average. So that is resistance for it right now. Now, the weekly expected move, I expect the options market to get this one right too. I don't think price action is going to move dramatically tomorrow either. We've got 205 on the upper end and we got 195 on the bottom end. I guess that's the one that we got to look at the closest, the 195, because we're closer to that at 198 on the close and the 200-day being at 199. Now, moving on, market breadth today, it also showed a lack of conviction for either side of the tape. Advancers led decliners by a 7-5 margin at the New York Stock Exchange and an 11-10 margin at the NASDAQ. All right, let's look at a very particular subsector, I would say. It has been strong but weak recently. Stronger today. That is semiconductors. So let me pull up the sector pie here. And if you want a copy of this, just let me know. I'll put it in the live chat for you or the comment section, either or. Okay, SMH, that tracks the Semiconductor Index. It moved in a positive direction today, closing right at the 5-day EMA, and it's just underneath of it. Let me pull this up real quick here on the right-hand side so we can see that closing price here together, 241.8, and the 5-day EMA is 241.5. So it did, just by a few pennies there, close above that 5-day EMA, which is important because that 5-day EMA had been declining because the past 2 days have just been harsh on semiconductors. But today, I'm glad to see that, and it's just barely closed above it. So that is a positive sign. It's also positive that it bounced off that 20-day moving average. So why did semiconductors do good today? Well, there were some strong movers within this sector or subsector, the semiconductor sector, because it's part of the technology sector. Wolfspeed. I know, a weird name, right? Wolfspeed. WOLF is the ticker symbol. Why am I talking about this random company, Wolfspeed? Because they had favorable quarterly results and guidance that sent their stock up over 31% today. Look at that ginormous green candle. It's like a rocket ship took off and it's just hitting the atmosphere waiting to break through. I mean, that is incredible how this thing moved today, up over 31%. Just wonderful. But this is what helped move the semiconductor sector today. And it wasn't just that they had good earnings, it was their guidance was actually on the positive side too. So the Van Erik Semiconductor ETF, ticker symbol SMH, it was up 1.4% today. Now, the strength here, it also helped to propel the sector that it is in, which is the technology sector. All right. Just saw your comment there. I'll get to that here and we'll look at that together. What do you think about and material sector in general? MP. Okay, we'll look at that. Let me just finish up here my thought on the technology sector. Let's go to it. I just lost my train of thought. Hold on. Okay, yes, technology sector. On the right-hand side of your screen here, it was up 0.5% today, which is good. And it was in second place as far as the big movers. Now, Cisco, which had good earnings, it also drove gains that boosted the information technology sector even higher. One other quick note, Bed Bath, Bath, and I'm getting them mixed up now. Oh my goodness, I should have just kept my train of thought. I'm getting Bed Bath & Beyond mixed up with Bath & Body Works, ticker symbol for this one, BBWI, and Tapestry, ticker symbol TPR. They offered some support to the consumer discretionary sector, which actually ended up losing today 0.04%. So basically a flat day for consumer discretionary, which has been performing pretty good recently after the quarterly reports. But Tesla had a modest loss today, and that weighed on the sector performance. Kohl's, ticker symbol KSS, though not in that sector, also weighed on the performance of retail peers, which traded down today, unfortunately, just like yesterday. Retail, and I'll actually pull that subsector up down here. Ticker symbol for retail XRT is the ticker symbol for the retail ETF. 2 bad days after a huge monster day. And we talked about the risk reward ratio, and it was way leaning to the risk side for retail, which isn't a good thing. I suspect tomorrow it'll just be flat. Maybe some buyers step in, but it is sitting right on its 5-day EMA. So short term, at least a small little glimmer of hope there for the bulls, since it is sitting above that. Okay, before I jump into the energy sector, let's look at MP here. Now, there is this, let me pull this up. There's a chart that I want to show you guys, and this will help to understand the material sector. Typically, when we're going into a recession or we are in a recession, materials do not do very well. Why is that? Well, when the economy slows down, companies aren't building the products that they need to sell. So volume goes down dramatically in a recession. If consumers aren't buying the products aren't being made. Therefore, it hurts the materials sector. Now, this chart, let me find it here right quick. Maybe this is it. It's an awesome chart, and it helps to explain why and which sectors. Oh, here we go. I think I got it right here. Give me a second. It's loading. It's loading. This will help answer that question about materials. It's all about the economic cycle and the market cycle. Oh, come on and load. It's almost there. Almost. Come on. You can do it. Okay. Come on. All right. There we go. There it is. Let me open that picture up now. So remember the first half of this year, the sector that outperformed all other sectors has been energy, right? Well, energy is typically the sector that performs the best when we are at the top, or when we have reached the top of the market cycle, right? And then once the market cycle starts to roll over, and this is what I want to show right here. Let me pull this over here. We've got 2 hills, an orange and a blue, okay? The orange hill is the market cycle. The blue hill is the economic cycle, right? Well, right above that, it shows you the sectors that perform the best when we're at the different spots on these hills, right? Whether we're at the bottom of the hill or the top of the hill. Right now, you can see energy at the peak of the orange hill. You have energy, which does fantastic. Materials is slightly up there. Consumer staples is also slightly up there. Now, I would say on this chart, we are not at the top of this hill. We are probably somewhere getting close to maybe crossing the blue line here, okay? We're probably coming down the orange hill, getting ready to cross below the blue line. That's about where we are in the market cycle and our economy, the economic cycle, because the economy, at least right now, is in paper recession. However, certain things in the economy do look good. Jobs look good, right? Even though it's a reverse looking metric that we use. So I would probably say we're probably about here, which means right now, healthcare, consumer staples, those are two that should do fairly well now and maybe in the next 3 months. As we continue falling down this hill, and when the market reaches its bottom and the economic cycle starts to fold over, then utilities, financials, and real estate do better. That's probably 6 to 12 months in front of us. Then the cycle repeats, and then we go back here. Once the market cycle starts to come back up and the economic cycle is nearing its bottom, technology and consumer discretionary do good. Then once we start marching back up the market cycle hill and we've reached the bottom of the economic cycle, consumer services, industrials do well. And then when we're almost to the peak, probably 2/3 up the orange hill, and the economy is improving, that's when materials will shine. And that's where materials will start to outperform other sectors. This is just an incredible chart right here. If you want, I can post it on Twitter. So that way you can download it. You can use it to help you understand where we are and what sectors do best when we're in that situation. Okay. At Ticker Time News, I'll post it there after the live stream. So with this right here, since we are coming off the top where energy has just been outperforming, we're coming off the top, the peak of that orange hill, and we're on our way down. Materials should be moving into last place as far as performance and relative compared to the other sectors that are out there. Healthcare, that's one that should be focused on in the short term because that should be outperforming other sectors. Consumer staples, they're probably getting close to their peak and maybe start dropping off shortly. Because as the economic cycle gets to its peak and then it starts failing and it starts dropping back down in this cycle, notice the bottom blue line and orange line down here. So the blue line, okay, full recovery for the economic cycle, right? That's about right here where the orange and blue line meet. And then it moves on to early recession. And that's about where the economy, the economic cycle has peaked and it's starting to come down, right? Now, on the orange bar at the bottom, it says market top. Obviously, that's where the orange hill peaks. Energy does really well. Materials are starting to come off of their highs. And then it goes to bear market, and that's when healthcare, utilities do well, and then financials start to pick up. But again, healthcare next 3 to 6 months, utilities in that time frame, financials probably 6 to 12 months or 3 to 6 months It all depends on how sharp of a recession we actually have. If it's just a paper recession and we bounce right back, then we move through this cycle a lot quicker. So I hope that helped to explain the material sector and where it's at. And you can kind of see, looking here at Materials Corp, ticker symbol MP, that they kind of reached this peak back here in April of this year, which makes sense. If I go back even further, how's this thing been performing? Okay. So that really was a really strong peak for them, which makes sense compared to those market cycles that we just looked at. Okay, let's look at the technical structure of where we're at right now. Obviously came off a big run, had a big hit due to earnings, positive, by the way. Let me just put a vertical line here to mark that out. So, all right, this is a bit of a short-term bearish bias here. The 5-day EMA, which is a very important moving average, it tells you what's happening in the short term with the stock. Since that 5-day EMA, since earnings has started to roll over like this, where price action was above it, but now price action is below it, that is setting up a short-term bearish bias. And the fact that it came up tagged that 5-day EMA today, but could not break above it, that just adds to another check mark for bearish bias in the short term. Now, it is above its 50-day moving average, which something I say often on the channel, bullish above, bearish below when it comes to that 50-day moving average, so that's good. The next place that I want to see for a technical picture here is how it reacts when it touches the 20-day moving average, which is coming up like that. Can it find support there? If not, how does it act with the 50-day moving average? Those are the next two spots that I want to see. If volume increases, which right now volume has been declining. Yesterday, volume ticked up a bit, but that was on a red day. There was a gap down there. But today, volume has fallen back off, and volume is way below its average. If I move this chart a little bit here, we can see average volume right now should be 3.2 million. Today, volume was 1.8 million. So for this to improve and get above that 5-day EMA or find support at the 20-day moving average, you need to see a spike in volume. Another thing that is kind of bearish here is that the MACD down here at the bottom has also rolled over, and it's getting ready to cross under the orange line there, which that is bearish, at least in the short term here. So I'm thinking not a good play for going long here, but if you are long in this one, looking for opportunities to add to that as it continues to pull back, I think is a smart strategy to do. If you're looking to short this particular company, then you want to see how it reacts to that 20-day moving average, which is, let me clean that up. The 20-day moving average right now is at 35.02. So just a few cents below where it is right now. So tomorrow, if you want this to turn around and start going in the opposite direction, you want it to break above that 5-day EMA, close above it so it holds that line, and that would be a positive sign for the short term. If it continues to fall, if it goes down tomorrow, you want to see that 20-day moving average and how it reacts and whether or not volume ticks up. when it reaches that 20-day moving average. And if volume ticks up and it can hold that 20-day moving average and close above it, then the follow-up is going to be crucial. And follow-up is the next 2 to 5 days. If the stock can stay above the 20-day moving average for that time period, then that is typically a bullish sign. But if it can't hold its ground for that time frame, then it's typically going to fall underneath the support area that it had. So that 20-day moving average in its case. So that's something I look at technically here for you. I know that was pretty detailed. I guess to sum it up, right now it is in a bit of a bearish bias. Also, with the cycles that we're in, materials are going to start lagging behind. So just two things to keep in front of your mind there when you're in the materials sector. So I hope that helped. You are very welcome. All right, let's keep moving on. I want to talk about the energy sector. So let me pull this back down and we can pull energy up here. One thing that was a little odd today, the dollar was strong. It was up today, and the markets were up today. The correlation has typically been that when the dollar is strong and the dollar is moving up, that puts pressure on equities and causes equities to go down. So your SPYs, your Qs, they typically go down when the dollar is rising. Today, that was not there. So something interesting to keep your eye on. Now, the energy sector, we had rising oil prices today. That obviously helped the energy sector. It was up 2.6% today, and it was the leader in the 11 S&P 500 sectors. Look at this. This is why I love weekly expected moves and knowing them ahead of time, because they can tell us a lot about what's going to happen over the next week of trading. Look at this. Today is Thursday. We go back a day, Wednesday, Tuesday, Monday. Monday was a gap down, and it closed nearly 2% down. And it landed on two things. It's 50-day moving average plus the bottom side of the weekly expected move, which was 75.6. Whenever, or at least 68% of the time, or a 68% win rate by close of day Friday, it should be within this range. And if you would like these ranges, we actually give our investor community on Patreon every Sunday evening. We give them the next week's worth of weekly expected moves on 35, 40 different products. So it's very helpful. With this, it bounced off its 50-day moving average and the bottom end of the weekly expected move. Typically, when it gets to the bottom end of the weekly expected move and it's at the beginning of the week, like on a Tuesday, you can bet that you can buy there and make a good long trade to close out on Friday or even Thursday or Wednesday, however long you want to hold open that position. So it is now rising, and it's now risk is starting to grow within the energy sector. Right now, if I were to put the boxes in here to show you risk reward for the energy sector, it would look a bit like this. Let me get the line in here. Line it up. Boom. Let me get one more box in here. And this is going to demonstrate to you how risk is rising. Line it up. Okay. Now let me change the color of the top box. We want this to be green because this is the reward that we could potentially see. Okay. So just using a visible two boxes here. All right. Tomorrow, Friday. Right now, The red box is the risk you have if you were to trade XLE and try to catch a profit tomorrow. Now, sure, intraday price action moves, but this is showing us that tomorrow our reward, which is the green box, is a lot smaller than the red box, which is risk. And the name of the game in a bear market is who can manage risk better, meaning who has the most money left over after the bear market. So managing your risk is key. And showing you this is letting you visually see that there is a greater downside risk right now in the energy sector for tomorrow than there is upside or reward. So these weekly expected moves help you greatly in identifying your risk reward ratio when trading. Major indices, the SPY, the Qs, the 11 sectors, semiconductors, retail, whatever the case may be. All right. Notably here, it was the only sector to move more than 1% in either direction today. And it was mainly because of oil. That's what boosted energy today. So the easiest way to look at oil, US, oil. One word, no spaces, on TradingView. And if you want to follow along and chart at home, there is a link in the description to TradingView. Doesn't cost a penny to use it. Okay, we've had this green bar here on TradingView for a while mapped out, and it has acted as support. And yesterday we were talking about oil and how, man, it is just right here under support. This is an area to watch closely. How is it going to react? Well, it reacted very favorably. It was up 2.4%, back above $90 a barrel. And if I pull this up so you can see, it's at 90.65 a barrel right now. So that is looking pretty decent. However, one thing I'll point out is with the breakout today, it broke back above its 5-day EMA, which short term, there should be a bullish bias here. Secondly, that trend line, that down trend line, has been broken. That's important. The last time it broke, we sold off the very next day. So that's interesting too. The other thing that I want to point out technically here is that it's not that far away. It's at 90.65. The 20-day moving average is at 92.1. So it's only a couple bucks away from resistance. So there's not a lot of upside that it could see here. Of course, it could break through. However, moving averages typically act like magnets, keeping price action very close to it until big volume comes and it breaks that. Or there's some big news headline or company earnings, something big, a catalyst that can move it beyond it. Now, separately today, several Fed officials made comments. So we had a ton of Fedspeak, including Minneapolis Fed president saying he does not know if the Fed can actually bring inflation down without triggering a recession. That's horrible news. And then St. Louis Fed president said he's leaning towards a 75 basis point rate hike in September. Let's pull this up real quick. Let's pull this up real quick. I want to show you where the market's leaning here as far as the September rate hike. Let it load. Just takes a second. Let me scroll down. We're looking for the two blue bars. There they are. These two blue bars represent where the market believes we are headed. On the left side, 60.5%. Well, they believe a 50 basis point rate hike. On the right side, we have 39.5%. That's a 75 basis point rate hike. So right now, the majority, not by a lot though, is leaning towards a 50 basis point rate hike. However, I'm interested to see what this looks like for tomorrow after the Fed speak today and talking about one of the St. Louis Fed president saying they want to see a 75 basis point rate hike in September. And adding to that comment, they were not sure if the worst of inflation has passed. Remember what happened to CPI in March. And I don't know if this is the right ticker for it or not, but let's pull this up. Nope, this is not. Okay, let me explain this anyway. This is not the right chart to look at. In March, we had 8.5% inflation, right? And everyone was freaking out over that number. Our latest reading was 8.5%, and everybody was dancing and hooping and hollering. What happened after March, though? Inflation ticked back up higher. The party that never started was over. What happens if the St. Louis Fed president is correct and inflation is not over, and next month, maybe 3 months from now, inflation ticks back up? How's the market going to react to that? Probably not very well. Then we have another comment from Kansas City Fed president, said there is a very significant difference between supply and demand in the economy, adding that she is encouraged by the July inflation report, but it's not time to take a victory lap yet because inflation could tick back up. That's not very positive news from Fed officials. That's actually kind of negative. Surprised the market was even up as much as it was today with the Fed talking like that. But so many people are convinced because of this rally that we have been in, that the Fed has just lost all credibility. They're behind the eight ball on getting inflation down in the first place. They shouldn't have allowed inflation to ramp up as high as 9.1% to begin with. So they have no faith in the Fed. So even if the Fed comes out and talks negative, they don't believe them. Now, the Treasury market is a little different place. It settled lower in a choppy session today. The 2-year, which we can look at that, US 02Y, the 2-year fell 5 basis points, which is really, really good. It fell from our resistance line that we've drawn out here. And we want that. That's what we want for the 2-year. But it settled around 3.2%. The 10-year fell 1 basis point. We can look at the 10-year. US 10Y, and you'll see that it held above its support. It's still moving in the right direction. We need the 2-year to come down while the 10-year goes up because we need to get out of this yield inversion. Banks don't like inverted yields. They don't do well when yields are inverted. Now it's settled around 8.88%. All right, tomorrow we got John Deere, which is a company I like. I like it for the future. And then Foot Locker, not a company that I like a lot, but I'm curious to hear what they have to say because, again, it's retail and it's in the apparel section. I'm really curious to see how they're holding up and what their report says. So those two reports come out tomorrow before the open. I'm excited for John Deere. I'm worried about the inflation aspect to hit John Deere and how they're doing. But again, I like them for the future, decade or longer, to hold that stock. But those come out before the open. Now, there was no real, there is no, I should change that up. There is no real economic data out tomorrow. So there's nothing out there that could shock the system, as it were. So I suspect that the SPYs and the Qs and the IWM will all stay relatively flat, chopping around, moving sideways, slightly up, slightly down. It's a toss of a coin right now. And this is a good thing because in the market, you have expansions and contractions. It's just like your heart beating. We have just gone through a huge expansion. Now we need contraction to take place. And that's healthy for a market to do. So even though it's really hard to trade the chop, and you should probably just not trade the chop to begin with, it's healthy for the market to digest all the information that we've gotten over the past month and let this rally cool a little bit. Let the relative strength numbers come down some. I mean, look at the RSI right here. This thing has just ballooned. It's at 75.5 right now. It's a lot of strength in the market. But we need to let that cool off and come down a little bit. And again, that's healthy. Think of it as like having high blood pressure. When you have high blood pressure, you need to get that to come down. You need to cool off a little bit, right? Have some peace in your life. Don't stress out. That's what the market needs to. Okay, that's everything that I wanted to talk about today. I enjoyed your company. If you could do me a favor and click the like button, that helps out a small channel like this. Also, sharing the video with a friend, that's helpful. And if you like this perspective, we have a whole bunch more of perspective, including weekly expected moves, which are like a cheat sheet for how the market's going to move in the next week. We have top 10 stocks in 4 different categories. We have numerous trade setups throughout the week, and not just any particular. We have 13, 14, 15 different types of strategies that you can use and the trade setups for those strategies. It is impressive, if I do say so myself. Just click the first link in the description or the pinned comment in the live chat and join our investor community on Patreon. It is fun, and the information is there to help you win in this market. All right. Thank you, ladies and gentlemen, for joining me today. I greatly appreciate your company again. And I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. So I'll see you then. Take care and have a good night.